talk about before we get out of here. We've already covered a lot. We've covered Chalamet. We've covered the pot raffle from the small exchange. I also want to cover what I think is especially pertinent. You talked about this with our mutual friend, Pete.
Balancing. The Cubs are awesome? Oh, no, I'm sorry. Go ahead. I didn't mean
the Cubs are, I am so sorry.
I didn't mean to interrupt you.
Have you been sleeping for the last month? Because the Cubs are the worst team in the league now, dude.
Yes, I'm glad we agree on that. But like you said, I'm sorry. I didn't mean to interrupt.
Balancing trading and investing is the topic of conversation, because this is one of those weeks, and you nailed it to lead off the segment. A lot of stuff is going on, but stuff isn't necessarily like going to new areas. For instance, I could be invested in 10-year yields. I could have bought the 10-year at, maybe I bought one at 14, I bought one at 13, I bought one at 12. This week, great action in yields in this market dropped from 12 down to 11 and bounced back. But if I'm just investing and I have these long positions, I'm doing nothing on a week like this week. But if I'm investing and trading and I'm balancing things well, then I can pair those investments. I'm long 3, like I said, from 14, 13, and 12. And then when this market on a day like Monday, Jermal, drops from above 12 down to 1150, I can trade with a short-term intention, and I could be on the same side. I'm long investing and I'm long trading. But as long as I'm balancing them correctly, which we'll get to, you can do both, right? Like I'm not a trader or an investor, right? I can do both.
Certainly, you can do both. Even within one name. And I think this is a great topic. And like you said, Pete and I kind of went through this yesterday on Tuesday as well. But I'm interested to go through it with you and get your thoughts, because I feel like sometimes it may take it takes a little bit of different mindset. You sort of have to compartmentalize a little bit, because what you said, and you just laid it out perfectly. This product has given you several levels to get in, and each time probably seemed like the one, right? And there's probably been little small bounces along the way, but not quite the bounce that you wanted. And then this week, particularly, we've seen some interesting, levels. We've seen, it drop below 12, in this case, 1.2. But it has given you different levels where you could, and there's probably some still people who are still holding. What week are we in? This is the first week of August, right? So we still got another 2 weeks before the roll. But, that has happened. I mean, that's been the situation here. Now, you probably have to change your mindset a little bit and look at different areas. Now we're saying, 1.2 is that big level, or 12. That's the level right now. That's sort of where people are looking at. And so it's kind of bounced in and around that over the last, few trading sessions. So you can change your mindset, but again, the idea of investing is totally different. You have a long-term view of it. You're looking at, you're not necessarily even looking at something every day sometimes in investing. Whereas trading, you're looking at very quicker and shorter intervals, right? And so you can do both. But I feel like sometimes maybe it's a different mindset. I usually compartmentalize a little bit. What say you?
Absolutely have to kind of, both in your platform and in your brain, just think of them separately. Like, if you are getting worked up about every 20-cent fall in the 10-year futures here from your investment mind, then you're not doing things right. Because I'll paint this picture. I trade yields on a mean reversion basis. So what does that mean? When they move far away from where they tend to exist, I am trading the other side of that. My long-term investment brain says, okay, the long-term average for 10-year yields the last couple of years is about 1.5% to 2%. So when this market is at $15, I don't really have a general opinion. In the last couple of months, it's fallen from 15 to 14 to 13 to 12. So my investment mind says, all right, I'll buy some 14s, I'll buy some 13s, I'll buy some 12s, knowing that this market could move through me. It probably will move through me. In all probability, no one buys the low, but I'm just holding on to this thing until it gets back to 15. And so when it moves, when I buy the 13s and it gets down to 12.5 or 12, I'm not screaming. That's my investment mind. But that leaves me plenty of room for days like Monday, Jermal, where it's like, okay, I can get into my trader mind, know that on a daily basis, this market has an average move of about 30, 40 cents using that mean reversion, same idea, just lend it to a different time frame and say, hey, this thing has moved twice what it normally does. Yes, it's to the downside. So I'm long in my investment mind and long in my trader mind, but I'm just looking for this short-term trade. And as long as I have mechanics around it, I'm not crossing streams, so to speak. Ghostbusters reference. I don't know if you've ever seen that.
Oh, yeah. Nice. I see what you
He
did there.
laughs at me like I'm some kind of chump. One of the 10 movies that I've seen is Ghostbusters. But yeah, it's a matter of keeping those things separate. And we'll talk about the mechanics in a second. But I want you to draw some analogies to the world that you come from, options trading, because it's a similar thing with a lot of people out there who see the edge in holding short options or short premium trades for the long term. A lot of people will have 30 to 60 day short options trades on in S&Ps or Amazon or, other sector ETFs and just roll, take that daily theta and everything else in the long term. But when VIX spikes, you're not just saying, oh, I'm not doing anything here. It's the same with I'm long 10 years. When 10 years have a big daily move, I'm jumping in, but it's kind of like having short strangles and everything else. And when that VIX spikes, maybe throwing on an iron condor or something like that. It's a similar mentality, right, Jermal?
Absolutely. I mean, I think this is probably the product immediately that comes to mind when you say those magical words, mean reversion. I mean, this is the product because, the VIX long-term average is a 19, but it has times where you get these spikes like you have here, above 20, above 25, above 30. And similar to what you were saying, like with the 10-year yield, if you buy it at 14, gets it there, you love it at 13, and you really love it at 12. Well, it's saying similar, but opposite here, right? You once it gets to 20, you definitely want to sell some. Once it gets to 25, you're definitely interested in selling some. The key, of course, is not to get too big, like we always talk about with trading, small trading often. You don't want to get too big in the situation where we discussed with the 10-year yield. You certainly don't want to get too big with volatility because volatility, as they always say, takes the elevator up and elevators move a lot faster than stairs. And so that's the whole idea. You take the elevator up, take the stairs down. Volatility can move pretty high, pretty fast. And so you always want to be careful with your sizing. And I think that's the real key there when you're talking about trading, investing. Trading is usually this type of short-term situation. You want to be careful with your sizing. You don't want to get it too big, too fast. Even some of the situations that I just talked about, some of the equity names where I've been playing, AMD was one of them. And I worked my way into a calendar, but that's not my core position. But my point is I was short some of the front month, and that's a situation where that vol was a little bit high. It was like 67, 68 vol, which is a lot more implied vol, not in rank, but that's a lot higher than normal. And so that's further upside. And that's breathing, if you will. That volatility is breathing and moving a lot faster. And so it's like you want to sell some of that. You want to get, sort of get some of that off. And that's against another position that I have in a further out month. So the idea here is, when volatility does spike, those are the situations where you look to sell some premium, or like we say in a tasty trade, those are the times where you look at getting short premium more in your portfolio. You're using more buying power because they present great opportunities.
Yeah, all great points. And it brings, I love the iron condor analogy to lent to the short-term scalping trade in futures, which is to say, you can have strangles on in S&Ps or AMD or anything for the long term, and you're defending them and you're adjusting them and you're just taking in that theta and everything else. When volatility spikes, that's when you throw, some iron condors out there, or you throw some other, like you said, you're trading like the shorter term options expirations. You go into the weeklies and you get a little taste knowing that I'm trying to get this thing out in the next 24, 48 hours, maybe next week, because it is moving a little bit more. Similar here with the idea of trading and investing with the futures product like the 10-year yield. The idea is just you've got to define that risk in the scalp, because you nailed it. The last thing you want to do is, okay, my investing mind bought 14s, 13s, and 12, my trading mind bought the 1150s, and then it went down to 11, and then it went down to 10. And now both trading and investing mind is just piling up these positions, and I have too big of a position on. And of course, the market can theoretically go anywhere. But by the time it gets to those historical lows, the same as like if VIX gets up to 60 or 70, I want to still have some of my account left. I don't want to have gotten too big. Same with these trading and investing ideas in futures. If the 10-year yield gets down to 0, I don't want to have too many positions on by that point. And that's why you can keep those investments on, like I say, buy the 14s, 13s, and 12s, knowing I'm waiting for 15s to get rid of these. Trading, you have to define your risk. You have to be mechanical and say on a day like Monday, oh, I'm buying the 11 halves. And if it goes 50 cents in my favor, I'm out. If it goes 50 cents against me, I'm out. Similar to the iron condor, it's like if volatility goes high, I sell an iron condor and it continues to rip, my risk is defined and I'm not taking out a bunch of contracts.
So that's a good point. Now, you kind of just touched on a little bit the idea of 50 cents up or 50 cents down. What are you looking at in terms of ranges right now for the 10-year? Because theoretically, volatility leads to bigger ranges, right? Like theoretically. Sure. And so you could argue that making the move that it's made recently, it's a little more volatile and the range theoretically could be bigger, although it doesn't seem like it's moved bigger. I don't think. I mean, I could be wrong. I don't know. You know more than I do on this product. So what do you think? What are you looking at in terms of ranges right now and how you trade this?
Sure. And we actually give these ranges out to our community members. Quick plug right there. And that we update those every single week. The 10-year is an interesting one, Jermal, because we are seeing growing volatility as like a percentage number. Like realized volatility is getting higher. This 10-year yield is moving more, but that's combining with a market that's falling in price. So it's almost like it's balancing out. Right now, the daily range in 10 years is about 30, 40 cents. So this was a great example from Monday where we saw a move of about 70 cents. And that's why I'm saying, like, if I'm invested in the 10-year and I see a 70-cent move, which is twice what's normal, I want to be able to trade that while being invested in there. And so, it is another good example that we're not touching on here today, but we'll touch on in the future, is the crude oil futures, right? Like that's a better one where it's like crude oil volatility is up and there's more opportunity in there, but the ranges have gone from $1 in crude to $1.50, almost $2. So you do have to adjust those things. But at the end of the day, you could do back of the envelope math. Like, your human instincts kind of kick in and it's like, oh, I'm trading oil because it's more volatile. And thus that means that I should widen out my expectations a little bit. And the numbers kind of fall in line with that as well. So I'd be looking for, like I say, 30, 40 cents in the 10-year. And you've gotten it multiple times in the last week or so, just the same as crude oil, looking for like $1.50, $2 in that market, which you've gotten several times this week. But we have to get out of here, Jermal. Great conversation. As always, man, you are the best. I'm glad that we got to jump on here and talk about balancing trading and investing. Anything you got going into the weekend or what?
I don't even know how to do it. How you do it? Heart? Something like
Heart.
that. Oh,
that's for you.
At it, man.
That's for you, man.
Buddy. You know what I'm saying?
I got a lot of love. Got a lot of love to give, man.
No doubt, man.
That's it. That's all Jermal has. I love it. Let's leave it at that. We're going to jump right back into the platform at Tastyworks. Splash into Futures coming up next, everybody. Stick around and thanks for watching. Peace.
Trade it up, people.